Hi there, this is Bruce, your local knowledge broker with Coastal Real Estate Company. And this is your monthly market update where I'm going to talk about the market both nationally and locally. So let's dive right in. Welcome to the May monthly market report for 2022. I'm Bruce Warzoa, and for the next 20 minutes or so, I'm going to walk you through some of the biggest topics in real estate today. Anything from this crash question, is the market going to crash? Second, where prices and where things are headed for the rest of the year. We'll talk about affordability as well, a big question on a lot of people's minds. Our goal is to give you the visuals and the information you're going to need to be the expert in everything that you need to make the right decision in this market. So let's hop right in and get started here. So first question, why we're not headed for a housing bubble. You just can't turn on the news and find something or hear something about the housing market and that may have some sort of inference or certain headlines. Is this bubble in a housing market? Is there a bubble? So I wrote a blog a few weeks ago why this housing market is not a bubble that's getting ready to burst. The central point of that blog was this graphic right here. So this shows home values going all the way back to World War II. So if you think about that, the reason we go back to World War II was that was the start of modern day housing boom here in this country. If you think about GIs coming back from the war and the GI Bill provided for education, provided for them to go out and buy a home. And ever since then, up until about today, there's been one time in this country where homes lost significant value, and that was back in 2008. So let's talk about 2008. So back in 2008, we saw homes lose value really for two reasons. The first reason was loose lending standards. You think back then, no income, no job, no verification, and we all know where we ended up from that. The second reason was cash out refinances. People took the equity they had, cashed it out, bought jet skis, boats, went on vacation, and lived the finance lifestyle. So they never thought that we would end up ending so poorly from that era. So let's recap here. Apply for a loan that you don't have to qualify for, and then take your equity and cash it out. And that's where we ended up in 2008 and why homes lost value. So I'm going to break down in just a minute. We've got some new graphics on how this market is different, but it's important as we set up this conversation that we understand that the one times homes lost significant value in this country, which was 2008 and the years to follow. Now, the other question that sort of plays into this crash question is everything comes out of the past 2 years in COVID. So forbearance, remember the tool that was given to those to help weather the storm from COVID, help them with their housing payments, help homeowners that may have had trouble. That's caused a lot of concern with people and what's going to happen from here moving forward. Well, the forbearance numbers continue to edge downward. As the most recent numbers in April, 690,000 loans still in forbearance, well below where we started out in May of 2020. I followed this story and I've been following the monthly market report, and I know that we've gone along and said, okay, what's happening to those coming out of forbearance and how this is going to turn out. And on the start of this, there was a lot of question marks about where getting a clearer picture of every day that passes. So one of the latest statistics that's come out is 92% of people that entered forbearance have come out of it, according to a Black Knight study. So here's a breakdown of those that have come out or those that took it, where they're at today. So those that have come out of forbearance as of March 31st, this is the clearest picture. 37% in the green area over here were paid in full. those are the ones that took forbearance maybe as an insurance policy. They didn't know what was going to happen. They didn't know if they would need it or not. 44.6% is the blue shaded area. And these went through some kind of work with their bank, either a modification, a rate and term refinance, or a deferral. So they tacked the payments that they skipped on the back. 4 out of 5 people either went through a modification or paid it off in full, and there were no issues. That's the blue shaded area here. That's a very, very positive sign when it comes to forbearance. Now, there are still 18% that are still in some trouble. So we don't know exactly what their circumstance is. They have no loss mitigation plans, and they're already in a loss mitigation plan. But the bottom line is, if you're talking about the crash, this is not going to factor into a crash because people have options. So if you've been negatively affected by the pandemic and you sell your home, with the appreciation that you've seen over the last couple of years, pay a commission, put some money in your pocket, and get to the other side of the crisis that you and your family are experiencing. So you have quite a few outs still to make things right here. So 2 things there. Understanding why we had the housing crash back in 2008, and then understanding the current piece of forbearance is critically important. But the bottom line here is we've learned from history that prices can fall. The important question now is what's going to happen right now and moving forward. And that is really hard to say. It's hard to say because things are very, very different today than they were back in 2008. So I want to walk through a couple more graphics today that do a good job of visually communicating how things are different today. So let's go back to 2008. Here's a graphic also for forbearance. Let me get back here. We've learned from history as to why this is different. I want to walk through a couple more graphics, and let's go back to 2008, the loose lending standards that drove the housing crisis. And let's look at where we are today in comparison. So the bottom line is lending standards are nothing like they were in the early 2000s. If you think back then, we talked about the loans that were in the market. We talked about things that people had done that caused the crisis. Well, there's 2 components that this report by the Urban Institute outlined. So first is produce risk in the mortgage business, and second is borrower risk. The red area right here is product risk. Think about that as a type of loans that are available to people, and that's been virtually eliminated. If you start back on the left side of 1999, which is right over here, we're talking about all the way up to 2021. You see that red portion, it's virtually gone in 2021. So the loans that were available back then are not available today. These are the loans from back then. These are those type of loans available today, which is none. So the brown portion right here, or orange, is borrower risk. So think about that as an asset profile, a credit score, all the things that it takes to qualify for a loan, and those have been severely curtailed. It's gotten harder to qualify for a loan after the housing crisis. So this was before the housing crisis, at the housing crisis. As this graph goes up, the ability to get a loan got easier, and it's gone down below where we were in 1999. So it's not that easy to get a loan right now. So when the qualified mortgage came out and demonstrated the ability to repay, all the things that we know about the mortgage business, about how hard it's gotten to qualify, This graphic tells a story of the differences between today, which is here, and back then. Today, back then. If you need further proof on how that this is playing out in the market, this has really led to sort of a foreclosure market in this country that's at an all-time low. Now, the last couple of years, certainly there's been a moratorium in place. This is a foreclosure activity over the last, since about 2005. Now, the last couple of years, certainly there's been a moratorium in place, and the federal government has stepped in and said, look, we're not going to process these foreclosures during the pandemic. Those are coming back, and we've talked about that before. But back during the housing crisis, there it is. There is the shaded in red. Over 9 million people went through a foreclosure. And we certainly don't want to see anybody go through that again. That's a tragic thing. But it's also a reality in our business. It's going to happen. But these tighter lending standards have led to less foreclosures in the market. Now, that makes a lot of sense, right? If you have a highly qualified or better qualified borrower, you're going to see less defaults, and we're seeing exactly that. So that is certainly not going to play into a crash, the foreclosure activity. If you need any further example of that, this is the look at loans that have been given to people with a credit score less than 620. So again, go back to the housing crisis. So many loans. This is a volume of billions of loans with a credit score less than 620. And where do we stand as the third quarter of 2021? The most recent information from the Federal Reserve, a fraction of where we were back then. So these were all loans with credit scores less than 620, and this is where those loans appear to be today. A lot less risky. So we can clearly say that the lending standards are different. This story is different. One of the major contributors back in 2008 is not around. The other question a lot of people are bringing up as well is as homes get expensive, people aren't going to be able to support the debt. That's a challenge. Well, mortgage debt is not a challenge. Again, this is from the Federal Reserve. This is household debt service ratio for mortgages, and that's a percentage of disposable personal income. So think about the total mortgage payments divided by the total disposable personal income. Where we sit today is much lower than where we were in the financial crisis, even lower than where we were in the 80s or 90s, as you can see by this graph. So why is that? That's a component of rising wages. That's a component of interest rates that we've seen. Folks that are holding mortgages today are much better positioned from where they were back in the financial crisis, the housing crisis of 2008. And I think there's a lesson from that we can take away is a lot of people said coming out of the housing crisis, we don't want to do this again. We're going to maybe pay down our mortgage. We're going to put more money down. We're not going to cash out the equity that we have in our home. And you can see that in the numbers that are coming out today. So what I'd like to do is show you next is the cash out refinance numbers. And I think they tell the same story. So this is a look at the mortgage payments on cash out refinances from Freddie Mac and the difference in the annual payment for cash out refinances. So if you think about it, the previous payments and then the new payment after the cash out refinance on an annualized basis. Back in 06, 07, 08, $3,000, $4,000 difference in the mortgage payment somebody was jumping up to be able to go through a cash out refinance. What did we see in 2020 and 2021? $66, $34. Very little change in the mortgage payment as somebody goes through a cash out refinance. Certainly that speaks to the low interest rates we've seen, but it also speaks to people not refinancing and harvesting the equity from their homes and going out and doing something else. A lot of lessons learned back in 2008 where we can say safely that the market dynamics are very, very different today in housing than they were back then. So as the question comes up, you can the bigger question right now is, okay, what's ahead, right? So I think many people right now asking, what is the rest of the year going to hold? We're here in May. The Fed started off the month by raising the Fed funds rate. A lot of people question that and talks down the road about a recession. So home prices are going up, interest rates are going up. So a lot of people have questions about where are we going. I'll give some perspective there. The most recent updated home price forecast from the 7 forecasters that we watch, these are for 2022 prices. The average of these forecasts is 9% appreciation. So many people saying homes are going to lose value later in the year. Certainly not what experts are saying for this year. If you see what the experts are saying, they seem to fall within 8 to 10% appreciation. So we started off the year at about 5% appreciation, and we've risen slowly each month since then. So here's estimated home price performance forecast for Q1 of 2022, 9%. So there's people that are definitely wondering, are we at the top of the market? Should I buy right now? Forecasts for price appreciation going forward may help them in making a more powerful and confident decision. So this graph here shows that. What the home price expectation survey does, as well as it looks at the cumulative house price appreciation by 2026. So optimists say 46.5% appreciation by 2026. Pessimists are giving it a 10% price appreciation. So depending on where you sit, I think even if you're a pessimist in this market, they're calling for appreciation here between now and 2026 of, at a minimum, 10%. All the panelists kind of agreed at a 26.8% would be a good average. So I hear people saying that they're going to sit on the sidelines and wait for prices to drop. They don't know if these forecasts are real, if they're actually going to happen. So I think it's important that we get this information in front of you so you have the accurate data and information to make an informed decision. So these are home price forecasts from those professional entities that we talked about. Based on the current estimate for the peak Fed funds rate, 3.25 to 4%. The 30-year fixed mortgage will likely peak at between 5% and 5.7% this year. There's some variability in that relationship. So we may see rates as high as 6% this year. This is going to depend on inflation, the federal funds rate, but I don't expect federal funds rate to raise too much higher than we already are. So what I'd like to do is jump into affordability. So as you see, all right, cut the video here and we'll start up on affordability. So let's talk about affordability. So a lot of people have questions about affordability and how that relates to the current housing market. Um, what I want to do today is walk through where affordability is right now and what it means for the housing market going forward. So let's start with a quote from Bloomberg. They're quoting the Harris poll saying, new data from the Harris poll show 84% of Americans plan to cut back spending as a result of price spikes. More than 70% of respondents said they're feeling the effects of inflation the most in gas prices and groceries. So I think we can all relate to this. We felt it at the gas pump, the grocery store. Prices are rising all around us, and it's impacting what we spend on a day-to-day basis. Now, for someone who's thinking about buying a home, that's a real concern, and it brings affordability into the equation. So where I think this is really impactful and it really puts the most pressure is on the first-time home buyer. That person who is looking to really jump into the housing market, build their net worth, their financial future, and it's becoming more challenging to do that. So these next few slides are going to show you some numbers behind what's played out over the past year or so. And when we think about the chart here, this is the change in mortgage payment. So it goes back to January of 2021. This is based on a loan amount of $300,000, principal and interest only. But if you look at January of 2021, mortgage rates were at historic lows. So a typical mortgage payment was about $1,200 back then. Fast forward to where we are today in the rising mortgage rate environment, and things are very different. So if we think about where mortgage rates are projected to go, and let's say mortgage rates later this year are around 5.5% to 6%, as we look at what the experts are saying and what's projected to happen, that mortgage payment jumps to over $1,700 a month. So if you're talking about $1,200 to $1,700, that's roughly a $500 difference. And that's putting a lot of concerns in people's minds as they're thinking about it costing more not only to buy a house, but also in the other pressures in their life. Like we said, gas pump, grocery store, all those other things, the first-time home buyer in particular is going to feel the pressure the most. So to further put this into context and really show the bigger picture, what we can see right now is the affordability is approaching historic lows. So this is the Housing Affordability Index. It goes all the way back to 1990. And if you follow along, you've definitely seen this before, but really had to break it down so that we could look at it. Is that the higher the bar, the more affordable homes are. If you look at where we are over on the right, they were over the past 10 to 12 years, they were certainly not as affordable as they were in those orange bars, which was the housing crisis. That's when distressed properties dominated the market. Homes were being sold at a massive discount. We're certainly not there, but as we've seen prices rise, mortgage rates rise, homes are not as affordable as they were over the past couple of years, especially during the financial crisis. So it's important to remember that affordability is really a measure of three key things. We mentioned prices and mortgage rates, but it's also wages. Right now, all three of those things are ticking up historically. Over the past couple of years, mortgage rates have kind of offset some of the rising prices. Well, we're not sitting in that seat anymore, so people are feeling affordability challenges. Now, the context that we love to add here, if you go all the way back to 1990, we can see that homes are more affordable than at any time leading up to the housing crisis. So I think that context is really key as we're having this conversation. When people say homes aren't affordable anymore, we have to say compared to when. Uh, Now, I want to continue to share this quote from the NAR because I think it also helps paint a picture of what's really happening in the world around us. It says the average consumer is spending an additional $429 monthly for items other than shelter. Meanwhile, the average weekly wages rose just $212 per month. So the consumer is now short by $217 a month, and that's all of a direct result of inflation and the things that we're seeing around us and how it's simply costing more right now. So this means the average consumer will be looking for a home that is $41,793 cheaper due to inflation and the additional costs imposed on them. So the average consumer that's looking to buy a home is reducing their price point. That is very real. So that is exactly where these dollars and cents are pointing to. However, the big concern I think that a lot of agents have on their mind is, does this mean that the price is going to impact sales? Rising mortgage rates, we know that's going to impact slightly. People are going to make a decision. They're either going to jump in and they're going to say, yes, I want to get ahead of this. I want to get ahead of rising rates, rising prices, or they're going to say that this isn't for me. It's going to cause people to make a decision either way. So the overall takeaway is that the buyer demand in the market right now is still very strong. This will not impact the overall demand that we're seeing right now. So many buyers in the market are selling fewer and fewer homes. They're seeing fewer and fewer homes. But the pressure is going to be on a lower price point buyer because the demand is still very, very strong in that price point. So, so the most important thing right now is you having the facts and relevant data and information to make a educated decision on if you should be buying, selling, investing right now. And I would love to have a larger conversation with you about your specific needs, wants, and goals, and see if this is the market for you or if you should wait. So reach out today. I'm happy to speak to anyone about where we're going and your current circumstance. You can give us a call. You can find us at Real Estate Wars on Instagram, or you can DM me anytime. Talk to you guys soon. I hope you enjoyed this monthly market update, and watch out for the next one, June 2022. Talk to you guys soon. I hope you enjoyed your monthly market update video. Don't forget to watch next month, where I'll provide all the information you need to make an informed buying or selling decision. And don't forget to follow us on Instagram at Real Estate Wars with a Z.